A lot of US data out this week, and I'm joined once again by Daniel Hwang, Managing Director of Alternative Investments Capital Asset Management, to discuss the main market movers coming out of the world's largest economy. Welcome back, Daniel. So let's start things off with yesterday's US GDP growth rate. Yesterday, US GDP rose at a 3.9% annualized rate, capping its strongest 6 months in 10 years. What can be attributed to this result, and how does it look for the dollar?
Right, GDP printed better than expected at a clip of 3.9%. But looking past those rosy headline figures, component data suggests that there's some headwinds to U.S. economic growth. So when we look at gross domestic private investment, that declined negative 14%. Exports suffered on the back of a stronger dollar, roughly 6%. So the outlook for the dollar from this reading is actually, if we look into the component data, is not as positive because improving U.S. growth figures, from the core and the components would suggest that we could see a Fed rate hike next year.
Just out today, U.S. durable goods orders unexpectedly declined in October, signaling the recent increase in corporate investment may not persist. As global markets struggle to improve, what does this mean for U.S. durable goods?
All right, I think there's a couple matters at play here. First off, looking at the core number, which excludes transportation, and if we further look at defense numbers, those numbers are pretty much attributed for the decline in durable goods orders for the month of October. So one thing where we did talk about in recent or past conversations was the significance of public spending, government spending on durable goods. And once we see that decline, that's actually we're seeing some of that impacted over on this number right here. So the other matter at play is the U.S. dollar. A stronger U.S. dollar, once again, will not have a positive impact on exports for heavy machinery. So we expect durable goods to continue to struggle moving forward.
Also out today was U.S. unemployment claims, up more than expected with an increase of 21,000 in the week ending November 22nd. Is this enough to indicate a stall in the U.S. labor market?
One positive is that U.S. unemployment claims, continuing claims, the 4-week average, still remains under the 4-week average. So that's a positive. But we do, take all of these numbers, the weekly data, with a grain of salt because of the fact of the noise around these numbers. In terms of moving forward and the U.S. labor market, we like to focus on NFP as well as employment figures coming out of non-manufacturing ISM. So we're going to take this with a little grain of salt here and see it as a positive that it stayed under the 4-week moving average for continuing claims. And we think that, heading into the rest of the week, investors have to look at and traders have to look at and continue to look at the divergence of data and what that will do to central bank policy expectations. So that's what's driving the markets, and that's what we're keeping our eyes on.
Thanks, Daniel. As always, it's great speaking with you. That's all from me for now, but do keep clicking back to the Dukascopy TV website for regular updates and exclusive interviews just like this.